If we haven't established by now that you and I do not want to pick sides in politics, I mean, like we say at every show, we are not political. We're not political. We don't like either side. Okay.
July being sort of an odd month as far as exogenous events are concerned, I think we can agree that as far as exogenous events are concerned, July was one of the weirdest months ever in my life.
I was out there.
But you still have 14%, almost 15% expected growth rate between now and Q2 of 2025 on earnings. And as we sit here today, 74% of the S&P 500 has reported 80% are beating estimates by 6%, by a median of 6%. That's a high surprise.
Welcome back to the Intelligent Investment Show presented by ARPG. Matt Dahl, thanks for joining me, man.
Good morning. Well, morning here.
Good afternoon here. I'll hop right in. We were just talking about this we're recording here, August 2nd? Yep. Is that right? August 2nd, about 1 o'clock Eastern time. And today is a bit of I called it a bloodbath. I hate to be so strong worded, but down 2.25%. And I was just kind of joking. We're at 53.25, which is awfully close to 53.50. That's a number you've said a couple of times.
Yeah. And I would love to be right about that by the end of the year, but I don't think I will be. This is definitely a viable dip. Definitely
viable dip.
Viable dip. The reason the market's obviously melting down today, I think it's a sort of a confluence of factors. The specific catalyst today, of course, was the jobs report that came in. Consensus was 180,000, 175, 185. Call it 180. Came in at 114,000. Significantly missed. That could be for a variety of reasons. I think it had a lot to do with what took place last month. Okay, because if you look, there's more people So 114,000 is weak. Okay, but what really moved the market today was the jump in unemployment from 4.1 to 4.3, which means there's more people looking for work now. Okay, that's really what that means. And there's something called the Psalm rule that got triggered. It's a 3-month moving average that looks back 1 year. So it takes every month, takes a 3-month moving average of the unemployment rate. And that got triggered today. Okay. And it says if that 3-month moving average moves 0.5% higher than the lowest point in the last 12 months, 3-month moving average in the last 12 months, then a recession is imminent. I tend to disagree with that. Okay, this time because of where we are at, we came from historically low numbers. When we were sitting at, an average of, 4.25%, 4.5% unemployment, that then rose to over 5, right? We're coming in from 3.3, 3.4 to a normal economy. This gets us back to our normalization versus intervention. Does the Fed need to intervene here? No, they're going to normalize here. Because these are normal unemployment numbers, and they're going to start to normalize the policy rate. Okay, neutral rate has been discussed these last few weeks. Appears to be 3%, plus or minus. What's happening in that smaller time frame, right? If we're at 3% and the economy starts to weaken, they might pull it back to 2, 2.5, whatever. If the economy starts to run a little hot, they might pump it to 3 or 3.5 or whatever. But we can kind of figure the neutral rate being right at 3%. Okay, which means we have 2.5% of restriction built in. So we are not normalized now. We are restricting right now by a tremendous. Nearly half of policy rate is restriction. If you believe that R*/the neutral rate is 3%, which I do. Okay. So, in fact, historically, it's been within about 50, 60 basis points of GDP growth. So if GDP growth is 2.5, 2.7, which is about what it's going to be. Okay, well, 3% is right there. So that's still a little high. So, I don't necessarily think that we are going into a recession or going into an economic, a real contracting economy that we need to worry all that much about. In fact, if you really dive in under the hood, to those labor numbers, we went from 4.1 to 4.3. But again, that's because more people are looking for work. But the labor force participation rate actually increased from 62.6 to 62.7% this month. So we have more working age people working than we had a month ago. But there's more people looking for work.
It's just the denominator of that equation that's changed. The numerator increased, which is really what leads to productivity, is people actually working. It's just the percentage went down because you have more people looking now. Is that kind of a summary of it? Yeah.
Correct. So when they send out that effectively that census every month, are you looking for work? Did you work? Right.
Yeah.
If you're not looking for work, you're not counted as part of the unemployment. If you are looking for work, you are counted as. If you are looking for work and you're not working, or you're underemployed, I guess, then that counts. But we have more people now looking for work, and we have more labor force participation, which is very good for productivity. We also had ECI month over month come in at 0.2 versus 0.3 consensus. So we now have wages are cooling down, which is really good. So this gets the Fed exactly where they want to be. I mean, the market's having a bit of a conniption fit today, and that's actually it's had a bit of a conniption fit since about July 16th. Frankly, got a little ahead of itself anyway. But the Fed is doing what it's supposed to be doing. It's normalizing the economy so that it can focus on both sides of its mandate. Both sides of its mandate being a healthy labor market and stable inflation, stable employment, stable prices. So prices have stabilized from all data that we can see. Labor has been fairly stable. It's starting to move a little bit, but it's not getting into a dangerous place. And I think, however, the Fed will acknowledge it. I think they acknowledged it at the last meeting just a couple of days ago. And what I think you're going to see Jackson Hole, on the 22nd, 23rd of August, I think you're going to see Jay basically. He's going to show up dressed like a California condor. He'll be in a dove suit. He will be so dovish at that Jackson Hole press conference, and he will fully acknowledge the labor force headwinds that could take place if they don't act.
Yeah.
Okay. And I think you're going to see the market just rally through September, and then it's going to get choppy into the election, and who knows what happens after that.
So I was going to ask the question, what the term buyable dip, I mean, what defines that? But you kind of answered it right there in your opening commentary there, or comments there, because you've got almost the perfect storm of data there to an extent, and things are cooling enough that the Fed can do what they want to do, but they're not cooling so much that it should spook the markets from the economy. The economy is healthy. It's just kind of resetting to a point now where you've got maybe a better entry point.
Yeah, if expectations are high, even good news can cause the market to come down because it's not good enough, right? But I mean, we have to put this in context.
What would have caused the market to not go down? Like, what was the market looking for out of these numbers? It sounds like what you're saying is a pretty healthy report.
I mean, I would have said the market to not go down today. It's kind of like swiping a credit card, though. Like, it's good today, but it's not so good in the future. So I think what's happened today is actually good for the longer term, right? But not good for today. That makes sense. Yeah. So I think a consensus level number, 160, maybe a slightly below consensus number. If consensus, according to FactSet's 175, Dow Jones had a 185. If we had a number come in somewhere between 155 and 165, right through there, that would have been a nice, cool Goldilocks level number. Like, coolish warm, that would have said, okay, well, labor's, and if unemployment didn't move or just moved from 4.1 to 4.2, okay, I don't think we would have had them. And the SOM rule wasn't triggered. Okay, those probably wouldn't have caused this sort of knee-jerk reaction today. Okay, but again, back to it's still, these are still healthy numbers. These are still good long-term healthy numbers. And the fact of the matter is, if you look at July, I think of July as sort of an anomaly, right? That's what I was talking with my team today about. And I said, it's a sort of a combination of factors. And I think it was Stalin that said it. We might have talked about this yesterday on the pre-production show. The meeting that we had is, we'll go years or decades and nothing changes. And then there's just a few weeks where the entire world changes. Okay. Yeah. And July of 2024 felt like that. Okay. We had this presidential debate. The world got upended. it changed the markets drastically as far as who's going to be the next likely president. That changed. Immediately following that, the next likely president, the former president, had an assassination attempt. 8 days later, the other party replaced their presidential nominee, somebody that nobody voted for. These are I'm not having an opinion on this,
sure,
but these are historical things. These have never happened. I mean, of course, we've had assassination attempts before, but it's been the last time we had an assassination attempt on a president or former president or presidential candidate was 1980, 1981. So you've got people now. We had an exceptionally hot July, by the way. The whole country was just ablaze, right? People were getting out of their houses because they were sitting in their offices. They were stuck to the TV, looked at this debate, and then bang, literally bang, Trump got shot in the ear, and then bang, Biden's out. So I think there was a lot of sort of hesitancy to do anything in July because people were frankly occupied. They were just occupied with this world-changing things that took place in a very short, compressed period of time. And this is a guess. I don't have any data to back it up, but it's just sort of I think we're going to have August when the number shows up the first in September. Was it September 5th or 6th? The next jobs report. I think that's going to show a pretty healthy number, and we could actually move that back. That 4.3 could end up moving back down to 4.1 or 4.2, depending on who's looking for it and who's not looking for it. Now, would that undo the Somme rule? Who knows? It could, right? Yeah. So there's a lot of sort of cross currents that are taking place right now, and the market is just kind of sloshing around. But to me, we're always looking 9 months ahead. This is absolutely a buyable dip. If we're buying this dip with both fists for sure. I don't know that it's necessarily done. I think this market probably has another week or more, maybe 2 weeks of call it a nice putting a sloppy bottom in, okay, before it runs up through into September. So
you're on fire with potential show names so far today. You came out with a nice one there, a buyable dip, and then sloppy bottoms. I think I love it when I already know the name of the show at the 12-minute mark. Buyable dips and sloppy bottoms.
Yeah, I'm pretty sure the listeners are going to be like, "What fraternity were these two idiots?"
Good question. We should have been in a fraternity together. I was not actually a frat boy, but I was the guy who wasn't in the fraternity, so I didn't have to do any of the work. I just showed up at the fraternity parties and got to reap the benefit.
I wasn't either. My brother was. My brother was a Phi Delta Theta. I wasn't in a fraternity though.
I like what you said there about, and it's interesting. You're in that transition period, right? And you hit the nail on the head there, and that things don't change for a long time, and then you go through a short period of time where a lot changes and kind of resets the deck, so to speak. And one of the interesting things that I would always point out to clients is that when you hear, this is not exactly an analogy to what you just said, but it kind of sets up the transition, I guess. When the market, when you say the S&P 500 averages 9% a year over some period of time, people kind of get in their heads that they look at their statements and most years it's up 7, 8, 9, 10, 11%. The reality is to average a 9% rate of return, you very rarely have a return over a 12-month period of 9%, right? It becomes 9% because you get a positive 18 and you get a negative 4 and you get a positive 12 and a negative 6 and a positive 2 and all these things over time average that. But the reality is if you look at a chart, it tends to go the direction it's going until at some point or another it changes directions, and then at some point that changes directions, and all of the ebbs and flows, ups and downs average themselves out to that 9% rate of return. And same thing with economic data or general trends in the economy and the world and political views and all kinds of things. Anytime you see changes, they don't happen gradually and in steady increments. They might start to head a certain direction, and then some big inflection point happens that suddenly resets the deck and changes things. And we've talked about, you talked about on the pre-production yesterday, you wanted to change our baseball field analogy. It was more like a football field, right? And that you have, and I think that's kind of where we're going with that is that, when you're, fantasy football, when my quarterback is on the field, I have an opportunity to score points for my fantasy football quarterback. And until they score or he throws an interception or the running back fumbles or they punt or they kick a field goal, I have that opportunity to score. But then at some point, you have the other team on the field. My quarterback's on the bench. As long as my quarterback's on the bench, he can't score points, and my opponent has the upper hand at that moment. So it feels to me like we're in like a critical 3rd down and 7 play where the outcome of right now, or we're at a phase right now that it's fairly likely that the next thing that happens could change the tide, could change the direction, or we could pick up the 1st down and keep moving steadily along like we are. But there just we seem to be more in like a 3rd and 7 situation in the economy than a 1st and 10 at midfield. When it's 1st and 10, the quarterback knows he's going to be on the field most likely for the next 3 plays at least, right? At 3rd and 7, it comes down to this one play.
Right. I mean, effectively, that gets back to our technicals versus fundamentals, right? So you have the football teams, they're on the field, and let's just say hypothetically, punting was not legal. You can't punt. Okay. And you have to run all four downs. And if you never cross through the line, if you never make that 10 yards, the other team comes back on the field on offense, and they don't go 10 yards, you're just going to be stuck in this range. So something fundamentally has to move. We have to get past that 10-yard move. We have to get beyond something has to change, whether data, whatever. There's something in the data has to move it. A running back has to grab that ball, get through the line, past the 10 yards to move the teams down to a different section of the field. And that gets us to the technicals versus fundamentals. So the technicals will sort of give us a range based on current data. And as the data change, it's going to move the technical ranges up or down depending on what you're looking at. And I think the best way to illustrate that right now is look at the bond market. Look at the 10-year, look at the 2-year. We've had the 10-year move 66 basis points since July 1st. 66. We were 448 on July 1st. We're at 381 right now. Here's what's even crazier. The 2-year Treasury note, which is more sensitive to your short-term inflation pressures, right? That has moved 86, almost 90 basis points, 86 basis points since July 1st. Okay. We now have the 2-year and the 10-year within 9 basis points of each other. Okay. So, we've had a steepening year this year where the 2-year has come down quite a bit in comparison to the 10-year, but now we're almost dead even. And I would suspect that there's going to be a fundamental catalyst, and I'm thinking that fundamental catalyst is going to be CPI it'll be PPI on the 13th or CPI on the 14th. Typically, the market looks to CPI as a little bit more of a barometer than PPI does. They're so close now, it could be enough to move it that I think it's going to be those inflation numbers that are posted the week after next that will move that 2-year, especially if they come in where we think. I think we're going to come in pretty light, especially labor is kind of a nice canary in the coal mine because ECI came out really light as far as the employment cost index wages. That came in at 0.2 or on a 0.3 consensus. So we have wages, services cooling. So I'm thinking the inflation number is could be shockingly low. Okay. That will move that 2-year right through that 10-year. Okay. Now we are in a different fundamental area. So what we were talking about, I think last show we talked about, I think we're sort of in this 385 or 375 to kind of 410 range or 415 range on the 10-year, which I think we are until something fundamentally changed. Well, the jobs report, that's a fundamental shift. Now here we are at 380. So my guess is as CPI comes in, CPI is going to come in light. We could move to a whole different range a little faster than we all initially thought. We could be looking at sort of a 340 to kind of 370 range on the 10-year, into the fall. Right. And our year-end target for the 10-year was sort of 25 basis points either side of 3, sort of 275 to 325. That's what it looks like. But we very well could. And again, I'm not making a prediction here because there's, data is going to come out. Things are going to change. Data changes, we change our mind. But I don't know that we're going to see a 4% 10-year again. I mean, not in this cycle, right? Not in this inflation sort of economic cycle. I think we might be done with that. So that's going to be wonderful for the real estate market and mortgages. Okay. In fact, a really cool little thing that came out today, and this is why we're really bullish on small caps to the end of the year. 40% of small caps are small banks, small and regional banks, right? And remember, the policy rate, to define what that is relatively simple. It's the rate at which the smaller regional banks borrow money from the larger 9 Fed member banks. The 9 Fed member banks being, I can't roll off all right now, but JP Morgan, Bank of America, US Bank, Citibank, Wells Fargo, Bank of New York Mellon, and on. Okay. Those 9 Fed member banks get money directly from the Federal Reserve. The smaller regional banks, your Zions, your Fifth Thirds, your MidFirst, all of those, Bank of Oklahoma, all of those smaller regional banks, they get money from the Fed member banks at that policy rate. That's what they pay for, 5.5% on the upper bound. So not today, but when this, about a week ago, we had about a 7% 30-year fixed mortgage rate. Okay. December of 2021, that number was 3.27. So you're looking at about a 3.75% increase in mortgages, right? Since December of 2021. Now, policy rate since then has gone up 5.25%, 525 basis points. So you can see that net interest margin compresses. They're only charging 3.75% more on their mortgages, but it's costing them basically 5 to 5.25% more for the money. So that net interest margin has really been tightened. So as that policy rate starts to come down, I think you're going to see a massive unlock in real estate. I think it's not just the unlocking the wealth in people's homes, it's the real estate people. The real estate sector, people employed in the real estate sector are, these are entrepreneurs, these are hustlers, these are strong people that make decent money, right? And they have basically been sitting with their hands in their pockets for the better part of 24 months, right? Mortgage officers, title people, real estate realtors themselves, right? So you look at, just anybody who owns a home, who their home value has likely gone up tremendously in the last 5 years, but they can't touch that. They can't touch any of that value because of where interest rates are. So as those interest rates really start to come down, I'm looking at a week ago, we were at 7%, 7.01, I believe, on the 30-year fix. We're at 6.4 today. It's come down 60 basis points in effectively a week. Okay. That's crazy. So that could be very, very, very powerful as it relates to the real estate side, unlocking a lot of wealth, American wealth, as far from their homes. And we're going to see a lot more capital flow from your smaller regional banks. And I think small caps are going to go, this is early cycle. That's what this looks like. It's choppy. It's weird. People aren't sure what it is, but that's what this looks like.
Well, and I was just thinking and doing some homework here while you were talking there. So it's interesting to me that if you look at the 2-year and the 10-year, where you've kind of talked about them converging, the 10-year right now, this morning it came 0.3 of a basis point from breaking through the December 27 low, right? So we were talking yesterday about that, and we talked before about that 385 to 415 range, but that's sort of a subjective number, right? Like you're going to go off the close, you're going to go off the average price, you're going to go off the low price. So the low versus low, we came 0.3 of a basis point away from breaking through the December 27 low on the 10-year, which I think was like 3.755. We were at 3.758 this morning. All right. So I looked at, okay, well, if that's on a 1-year chart. If I back out and look longer term, we broke through that level at like from below this number to get above 381 in May of 2023. We got through that 381. So this is the first time we've gone below the 381 level since that point. Now, the 2-year has a different chart. It also broke through its low today, but it didn't just test it, it shattered it.
Yep.
But that low in the 1-year chart was January 12th, and it was 412. And we've broken through that at like 390. So we've shattered that on the way through. So then when I go back and look at, okay, well, at what point did we get above 390 the last time? That was September of 2022. So the breaking through that, what is now maybe considered the floor on the way up, was 8 months sooner for the 2-year. The 2-year broke through what was the floor back in September of 2022. It took the 10-year 8 months to do the same thing. But now, even more recently, the low versus the low was a month apart. So the 10 and the 2 do not run parallel to one another, right? They just happen to be right now at this point where they're both kind of at that same, they're both testing lows or breaking through recent lows, but the lows themselves were months apart and not correlated to one another. So is that sort of an illustration or an example of what you're talking about, that resetting and getting them sort of back in line with one another? Because to me, you're right, that's tightening the spreads. To me, that's evidence of what you just said, right? That now the net interest margin is compressing for the banks, but where is that going? It's going to the people that they lend money to, small businesses,
right?
Which is good for the economy.
Well, and the 2-year came down in far more rapidly than the 10-year, as it should, because the 2-year is sensitive to your shorter term inflation pressures. And clearly, just like the bond market did in 2021 and 2022 and 2023, the bond market did the work for the Fed. The bond market was well ahead. I mean, we had the 2-year well ahead of policy rate in 2022, okay, by a tremendous amount. Now we have the 2-year well behind policy rate in 2024, and it's going to continue that way. So this is the bond market doing its job. This is the bond market doing the work for the Fed, and the bond market is absolutely looking for signal from the financial markets. Okay, and I think this is one of those times when they have to fully acknowledge. I wouldn't say that they've won or they beat inflation, but at the very least, that the other side of their mandate is equally, if not slightly more important now, bringing that into consideration versus inflation, because inflation looks to be fairly mitigated, right? And my guess is you're going to see the 2-year go right through that 10-year. We will probably have a yield curve that looks very, very healthy by the end of this year. Even if we're sitting at 325 on the 10-year, we could be looking at a 250 on the 2-year, okay, or lower, because if inflation, again, PC sitting at 2.5, 2.6 right now, okay, what that looks like in December, the bond market's going to be there. The bond market's going to be there. So you're going to see just a lot of I think healthy activity from the real estate sector coming in. The other thing that's going to do is, of course, and I think this has to do with sort of a, if Trump wins, right, that's going to provide a lot of CEO level confidence, and we saw something specifically about this. I'm not picking a side, so I'm not picking a side, but I think that's going to be good for the IPO markets.
If we haven't established by now that you and I do not want to pick sides in politics, I mean, like we say at every show, we are not political. We're not political. We don't like either side. Okay.
Well, in our meeting this morning, my advisor asked me, well, who's the beneficiaries of the IPO market really starting to open back up? I said, well, I mean, it's going to be good for, sort of your capital markets companies like your CMEs and your NASDAQs and certain aspects of your larger banks, Goldman Sachs, those types of banks will do well. They do underwriting, Morgan Stanley's and JP Morgan's. Okay. But it's not much of a needle mover in and of itself. What it is more of a barometer, right? Because the IPOs, no one's going to, if you're a company and you want to go to the capital markets, well, do you go to the credit markets and borrow debt? Do you go to the equity markets and release capital and release equity? So if you release equity when the markets are bad, like they were in 2022, you're going to get a very low value. So you're not going to want to do that. If you go to the capital markets in 2023 and 2024 and things are better, but interest rates are very, very high, well, you're not going to want to do either. Yeah. Right. So what's likely going to happen is as interest rates start to come down, you're going to see private credit not do as well, because private credit has their own war chest. They've been loving the last couple of years because they've been lending money at just great margins, right? Whereas the banks, they're getting their money from the Federal Reserve, so it's a little different. So, but what's likely going to happen is as capital starts, as there's more accommodation starts to come in, I wouldn't call it accommodation, but less restriction built in, you're going to start to see that IPO market really start to free up, because that should be good for the equity side. Valuation should continue to just do really, really well, especially on the smaller end of the capitalizations, right? I think that's going to be really good for the IPO. And that's just kind of a good barometer. And again, you get good IPO activity. I mean, you kind of get good IPO activity at the beginning of a cycle, and you get good IPO activity at the end of a cycle. The end of the cycle was 2021. Beginning of the cycle, 2024. Fair?
Well, and to take that example, I'll add one more time period in there. If you go to the capital markets late 2022, it was a worst of both worlds. You're not going to get a good deal on the equity side because markets are low, but it was going to be really expensive to borrow at that time on the short term as well. I don't have the rates pulled up, but that was when rates were first starting to go up. So it wasn't a good time to buy or to borrow or to raise equity. Quick question to end it on here. I think this is a good way to kind of wrap this. So we, on the pre-production call yesterday, we also talked about earnings. And I think in the context of, we're mostly through earnings reporting now, but there are still a few big ones to report. I think one reported, I don't think we had any big ones today, but we have a couple more coming up next week, and we've had a couple more report this past week. Do you think these last couple that we have to report, and you can tell me who they are, what is your buyable floor? You kind of said this is a buyable dip, but you don't know that it's done. So if you wanted to say, okay, best case, if these remaining companies that have left to report, if they come out with really good earnings, this is our floor. And if the earnings miss or we don't like what comes out in the earnings reports, this would be my floor. Or option C, it really doesn't matter what they report. Your floor is not going to change either way in terms of where are you pounding the table and telling your guys to get in there and start buying?
5260 on the S&P. I don't know that it will get there. Okay, but that would be a pretty nice little floor. That's exactly a 50% retracement of the move from the April 19th low of 49.53 to basically 46.67. Or sorry, 56.67. So that's a nice 50% retracement. Don't know if we'll get all the way down there. We might get pretty close. Because here's the thing: Amazon actually beat. They posted $1.26 on a $1.03 consensus. Apple posted $1.40 on a $1.34 consensus. The average price target on Amazon is still $2.25. It's selling off today because they gave kind of weak guidance on their retail side as far as their consumer side. So it wasn't really weak guidance; it was just unclear. It was unclear guidance, right? And they cited the weather and July being sort of an odd month as far as exogenous events concerned. I think we can agree that as far as exogenous events are concerned, July was one of the weirdest ones ever in my life.
I was out there.
But the thing is, okay, what do we have? We still have a 14%, almost 15% expected growth rate between now and Q2 of 2025 on earnings. And as we sit here today, 74% of the S&P 500 has reported for Q2 already. 80% are beating estimates by 6%, by a median of 6%. That's a high surprise. So earnings are good. Interest rates are still headed in the right direction. This election sort of fervor, I don't want to call this.
There's not a word for it.
Weird manic summer is going to come to an end.
Yeah.
And things look to be pretty good. I think what we're going into 2025 looks like strong earnings, strong labor market, a normal labor market. Okay. Likely a very pro-business president, interest rates that are going to be less restrictive, and a growing consumption population. Yeah. Funny is Tom Lee at Fundstrat said it this morning, and he beat me to it because, although, millions of people listen to him and probably millions of people don't listen to us.
Not quite.
The VIX spiked to near 30 today. It went to like 29.8, and it's all the way down to 25. That is psycho panic.
Yeah.
That's when you buy.
Yeah, you don't get above 30 very often on the VIX.
Here's the thing. It closed last night at 20 or 19. It went up 51% today.
Yeah. And for listeners who may not follow that, that's the volatility index, which basically it tells how much people are paying for options, which is generally people. There's more to it than this, but people tend to buy options when they're trying to protect or hedge against the market. So the price of options goes up when people get scared, and normal is 20. And then when you're
historically it was around 15. So it's the price of a put option.
15. Yeah, 15's closer. Yeah, 15's closer to the average.
It's the price of a put option on the S&P 500 30 days from now.
Yeah.
That's what it is. So the higher the VIX, the higher the price of your protection 30 days out, the higher the VIX goes up. So when you see volatility spike, people start buying protection. Well, as demand of that protection goes up, the price goes up. And it spiked 50% one day. Yeah. So, okay, that to me, I mean, I don't want to get ahead of myself, and I kind of, because August can be a gnarly month, but this feels like a capitulatory day. Yeah. It just feels like the end of a cycle. So I don't know that we will get to 52.60. My guess is we will get in that range in about a week and a half. But
we're only a percent. We're only a percent off of it now. I mean, we're not far from it.
This could be the end of this. This could be the day. This could be the end of this.
Yeah,
because this is a bad day, and usually bottoms are nice and fat and sloppy at the end of a little mini correction cycle.
But it doesn't sound like you think so. If do we have the companies?
Sounds like a country song.
It really does. It's either country or rap. I can't tell. That's how dynamic of a quote that is that it could be country or rap. I'm really not sure. So the companies tell me the companies are still reporting. Who's still to go?
Oh, well, 170 companies reporting this week, but we still have. So, I mean, basically, Apple has reported, Microsoft reported, Amazon's reported, Meta's reported. They've all done very, very well. The next big one to report is I would say is market moving is NVIDIA, and that's not until the 28th of August.
Okay. So you don't see there's not really a big announcement coming up in the next week or two that is going to necessarily play a huge role in what the market does. So your floor of 52.60, you've pretty much got the information to say I don't see anything else that's going to make me want to change that floor. 52.60 is that's kind of what you've got is that 50% retracement.
I don't know that it will even get there.
Yeah.
I mean, you're right. We went to 50 right at. I haven't looked. I don't know that we got to a 52 handle today. If we got real close. I know we got to 53.04 or something like that, but I don't know that we got to a 52 handle today. I'd have to take a look.
Our low today, we got to 53.02 as of 1:42 Eastern time on August 2nd. We got to 53.02, but that's the low of the day at this point. So not quite.
That's pretty close to a 50% retracement.
Yeah.
I don't like the fact that it came this early. Usually when you have, I like. And I wish I could say this is what I like. I like it because I learned this from, some much better technicians. Mark Newton, again, I think Mark Newton's probably the best of the best of the best, but he likes it. And I like it when the time and the price line up.
Yeah.
If we can get to that 50% retracement at 50% time. So if you're looking at effectively April 19th through July 16th, I mean, May, June, July, you're talking 12, 13 weeks. Okay, call it 13 weeks.
Yeah.
So, if we can get a 4.5 week move, so July 16th to call it an August 16th low at 52.60 would be like, oh, okay, now we know it's over. Perfect. Yeah. On a capitulatory day, that's what it's supposed to look like. Problem is, we're a little bit higher than that, and we're a little bit early.
Yeah.
But these are just general ideas in technical motion, right?
Yeah.
So things could turn around and go the other way, and this could be the end of it. Anything's possible. I mean, we could finish today. There's a likely scenario that we finish today 52, 60, 70, 80 right there. And Monday, we take off and go to the races, okay? The other scenario, there's three scenarios, actually. The other scenario is this thing turns around today and actually finishes higher. I know that sounds crazy, but it could be one of those days. Okay, I think those are both of those scenarios are pretty unlikely. I think today is probably going to finish better than where we're at, but not good.
Well, and there is a technical term for that. I think it's called an engulfing bottom, where if you get a lower low than yesterday and a higher high than yesterday in a downward trending market, that tends to be a reversal, and then it's the opposite on the upside. If you get a higher high and a lower low at a top,
it's either a bullish or a bearish engulfing pattern.
There you go.
Bullish or bearish engulfing candle is what they call it.
Candle, yeah.
So if we went higher than the high of the day before and lower than the low of the day before, but then finished above. It matters where it closes. We have to close higher than the high of the day before. But during the day, we had to have gone lower than the low of the day before.
Correct.
So today we go, I don't know that we were higher than the day before. I think we were actually a little positive today. No, we were higher today than we were yesterday at some point. We finished lower than that could be a bearish engulfing pattern, which would probably be likely because we're right there now, actually. And if they close the market right now, that's where we would be. So
the high right now for the day is 50.
We probably got another week and a half of this.
The high today is 53.83. The high yesterday was 55.66. So we would have to touch higher than 55.66 and close higher than 54.46. So
yeah. So we're nowhere near. We're nowhere near the engulfing side on the high end.
Right. Yeah.
So I don't. So I think this is just one of those good old fashioned third quarter chop.
There you go.
You just
third quarter chop, Buyable dip,
listen to yacht rock, and enjoy your summer. A
Buyable dip in the middle of a sloppy bottom of some third quarter chop. I don't know. We'll figure out how to piece all that together. Yeah. But as always, despite everything that we say on the show, it is only for your entertainment and education purposes only. Matt and I are not giving you financial or investment advice because we do not know your financial situation. If you would like to talk to a professional who's really good at what they do and who knows all this stuff and who would like to get to know more about your financial situation so they can give you financial advice and investment advice, Matt and his illustrious team in Las Vegas at ARPG can be reached at
702-655-8300. Or go right to intelligentinvestment.com. My team is illustrious. I am not. Without them, I am nothing. Without me, they are better.
Your hair's looking nice again today, though. You've got back-to-back pretty decent hair days for the show. I don't know what you stumbled on last week, but...
You know what? You're not wrong. I look pretty solid. This is good.
Also, if you're watching the show, so if you listen to the show on Apple Podcasts or on Spotify, there will be a link in the description to intelligentinvestment.com where you can go straight to Matt's team. If you're on Wealth Partners website, the link's all over the place. If you're on YouTube watching it, check the description. There'll be a link to intelligentinvestment.com there. On Wealth Partners website, if you're at the show page, you can scroll down and send me a message if you want to share some information, and I can introduce you to Matt. I put everything out there that I possibly can to give you ways to reach out to Matt if you would like. Also, if you are still here, like the video, subscribe to the channel, follow the podcast, do all that good stuff to make the algorithms think that we're popular and will put us in front of more people. And appreciate your time. And if you're still listening and watching, appreciate your time as well. Until next time, brother, always enjoy it. Talk to you in a couple of weeks.
Talk to you in a couple of weeks, man. Take it easy.
All right. See you, dude.